Stocks soar 1,000 points after the prospect of a $1 trillion bailout made the markets happy. The Fed has gone to another level with their bailout strategy, but they have now exhausted all options. At this point, we are too far to turn back. 0% interest rates are here to stay until inflation heats up dramatically. For now, we can expect this to either be resolved or for the Fed to buy stocks. You came here for the truth, so let me unveil that for you. We are living in unprecedented times. Surely the history books will be written about what we are dealing with today, so it is an interesting time to be alive. I have an extremely large amount of data to cover. Let's get into it right away. The big news of the day, of course, is the $1 trillion in stimulus, which I do want to cover at length, but I just wanted to mention it here to lead off into the video. The markets were waiting for both monetary and fiscal stimulus, and the monetary stimulus is there. They're just waiting for the government to come in and push out a whole bunch of money. The Fed in the morning announced they would reopen the so-called Commercial Paper Funding Facility, so CPFF, you might see that referenced, to underwrite the short-term loans that companies often use to pay for their operations, a key financial market backstop first set up 2007 to 2009. So it's not the first time this has ever been used, but now it's coming back online. At day's end, it extended its reach as the economy's lender of last resort to the 24 Wall Street primary dealers who are critical to the functioning of bond and other financial markets. It gets into more detail in here. I wanted to show you the next article. The Federal Reserve is providing help to companies that are having a hard time getting the short-term funding they need to operate. I think this is a little bit ridiculous. I just have to interrupt myself because the challenges are with the actual financial system itself. It's rotten to the core. All of the money that they've been trying to get out there, the liquidity with the Federal Reserve repo operations has not been working at all. They're allowing up to $500 billion and they're not even anywhere close to that level. They're trying to urge these corporations get in, use the facilities that we have, but they don't want anything to do with it. They're not playing ball, and this, of course, is having an impact on what we see with liquidity. This is crucial market for basically short-term borrowing by companies, and if you don't get this short-term borrowing, you can't get payments out, you can't pay your employees, you can't pay your customers. If this freezes up, it's a real problem. Why in the world is this happening right now when we were told just a month ago that everything was completely fine within these companies? There's no problem here, but now all of a sudden there is a problem. Something is very fishy. March 17th, Federal Reserve Board announces establishment of a primary dealer credit facility to support the credit needs of households and businesses. Just quickly to note, the PDCF will offer overnight and term funding with maturities up to 90 days and will be available on March 20th. They're claiming it's going to be 6 months, but in case they need to, it will go longer. We'll see how this all plays out. There's more specifics in here if you want to read it. Let's move on. Now, the CPFF, in the previous instance, we're looking at the financial crisis time frame. For those who can't see, the font is quite small. This is back in 2008, and this right here is 2009. And you could see what had occurred. Obviously, a lot of these different corporations were getting in on this, and then slowly, as time went on, this faded away. I'd be interested to see if this is the same type of pattern, or maybe they won't want anything to do with it. Who knows? We'll see, and I'll bring that to you as it unfolds. Fed President Neel Kashkari says we are using our tools aggressively, but he doesn't see negative rates coming. Isn't it interesting that they are most likely going to have to go in that direction eventually, and yet there have been many from the Fed that have said, no, we're not going to do that, we assure you. And of course, they don't want to say that they'll ever go there because then the market won't be satisfied. They seem to want to go towards more quantitative easing, more money printing, and of course, like I said so many times before, they're most likely going to buy stocks. That's where they'll go. That's the direction they're heading. But certainly negative rates are always on the table. Don't let them ever make you think otherwise. Crude oil has been taking a serious beating. You could see it at $27 a barrel for WTI. Brent crude is barely hanging on, is just above $30 a barrel right now. As always, it is volatile, but it's so critical. You need to watch oil on a regular basis. Keep your eyes on it. I'm going to talk about this as well as another article. I got a chart here and then give you some historical context of why this is extremely important. Essentially, the Treasury Secretary wants to be able to provide individuals with money. Okay, so we're talking about a bailout for the people. Supposedly, that's what's going to happen. They said it will come in multiple rounds depending how long this lasts. We'll see about the job losses and so on. It's all part of a huge stimulus package, potentially as much as $1 trillion, but that's just a number at this point. We'll see what happens when it actually goes through. I'm sure they'll pass some sort of stimulus, but who knows what the number will be. This is where it gets interesting. Treasury Secretary Stephen Little Munchkin raised the possibility with Republican senators that U.S. unemployment could rise to 20% without government intervention because of the impact of the situation that's happening today. This little individual is starting to scare those people in the government to make sure that this goes through. Where have you heard this before? Has there been any historical examples of that? We'll talk more about that in a second. Of course, he was speaking with them and suggested it's got to be $1 trillion or more. That's the plan. That's what they want. He told senators that he believes the economic fallout could be worse than the 2008 financial crisis. Extraordinarily high unemployment, he said, is a possibility if they don't provide financial assistance, and it goes on. Think about this for a second here. He's putting the threats in. He's saying you got to pass this law. Do it right away or there's going to be trouble. The U3 unemployment rate peaked out at approximately 10% during the financial crisis, and then we saw over the years, slowly but surely, that number came down. Right now, 3.5%. It is historically unbelievably low, but just like in all of the previous crises we have seen, it changes rapidly. Everything's heading downward, and then suddenly it spikes up. Heads downward, suddenly it spikes up. It's as if it comes out of nowhere, taking everyone by surprise. This time, looks like it's potentially no different. Well, we'll see what happens. According to the Treasury Secretary, this will be an unprecedented level, 20%. I don't necessarily think that that's going to be the case on the U3 unemployment. I'm not talking about real unemployment, but the U3 number, he's suggesting this could happen. Now, how many people remember back during the financial crisis where many of the lawmakers were told that if they didn't pass the TARP bailout, that some of the worst things ever would happen? I can't even say them on this platform. There are so many stories, so many quotes about what the Treasury Secretary, Hank Paulson, did at that time, basically doing the exact same thing this time around. To me, this should be setting off some alarms, but of course, it will go underreported. Guggenheim had this to say: shock and awe falls short. The Fed still has a number of tools at its disposal that haven't yet been implemented. Now, it looks like they posted this prior to the knowledge of the Federal Reserve setting up this facility again. But what I really wanted to note here was this part. Given the size of our economy relative to where it was 10 to 15 years ago, it would probably be appropriate for Congress to pass a TARP-style program of $2 trillion. So that $1 trillion number that we're seeing here, I don't necessarily think that's going to be enough. But maybe they'll get that number, or maybe they'll get somewhere around it, and that's just round one. Still got to be around two and around three, and who knows how long this is going to drag on for. Because maybe round one fixes the initial problems, gets the funding going, gets people to spend money, but what if we have a cascade of the debt, the corporate debt for instance? Then we're going to need a round two. Then we might need a round three because of something else happening a couple months after that. It all depends on how the events unfold. There have been a lot of predictions about what's going to happen with the GDP, the effects of this, and everything involved here, and I just want to show you one of them. We now guesstimate that the second quarter GDP will drop at a 10% annualized rate after a 2% fall in the first quarter. There are so many I've seen, and all of them look bad. I mean, they go from bad to worse. So whatever it is, we know that it's going to be negative, and we need to be braced for more bad news to come out. The problems that we had back in 2008, how one point connected to another, that corporation was insured on this thing with the CDS and everything else, and that, according to this, is not priced into this market. questions are becoming, how steep of a recession are we going to endure? Goldman Sachs, right now, I'm going to show you this in a few minutes, literally says we are in a global recession. But I know the question on everybody's mind is, how bad is it going to be? GM is offering 0% financing for 7 years, deferred payments amid the issues we're dealing with today. The auto industry right now is taking a beating, as you know. It was happening before this year, when really has accelerated just over the last little while. A lot of different companies, local companies, big corporations, they're all hurting in their sales, their revenues, and they are really reaching out to their customers and trying to do everything they can to hopefully keep the machines running. This information comes directly from Boeing's website, and essentially they want a bailout. Boeing supports a minimum of $60 billion in access to public and private liquidity. This, of course, brings me to my next point. Boeing's cumulative share buyback since 2009, and of course you can see it began in 2013, where they added billions and billions of dollars in share buybacks instead of saving for a rainy day. I talked about this on my Instagram. I've been highlighting what's been happening with companies when they get bailouts. See, the CEO gets to feel real good about it, but time and time again we see these mass layoffs. Don't you think it makes a little bit more sense to be putting that money away into something safe, into something secure, to be able to withstand a problem that is really only a month long? Are you trying to tell me that all of these corporations around the world can't withstand one really bad month? Sure, that might go on longer and longer and longer. But why is it that you as an individual don't have the same advantages that these mega corporations do? They're going to get their $60 billion. They're going to get whatever they want. And maybe, just maybe, if you're lucky enough, you'll get the crumbs. Before this crash, many big corporations broke the #1 rule of personal finance. Giant employers of lower wage workers spent and borrowed money for stock buybacks and dividends. Now companies are trying to tap credit to manage cash and avoid layoffs. All that money they put into the buyback could have been used to shore up the balance sheet during the bull market to better prepare for a financial downturn. But why would they do that when they could just get bailout money? Largest concentration of 3% moves since the financial crisis. This is where we are at today. This was October 2008. This chart goes back to 1950, and this is the second highest we've seen. Median S&P 500 stock bid-ask spread as a percentage of the price. This is important to note because we have a problem with liquidity. Look, when markets are operating fine, they're moving up, everybody's happy, everything's fantastic, you don't have to worry so much. But it's when people need to sell, when people are worried, this is when you have big issues with liquidity. What you think it's worth isn't what you're gonna get, okay? That's just the way it is. And in some cases, people are being locked out of their accounts. Maybe the value has come down too far and they're not interested. They want to hang on now and their whole plan is screwed up. They didn't expect it. Always be prepared for the worst. Here's the 2-year, 10-year yield spread. And of course, previously we had the yield curve inversion. It has come up from there ever since, and it is going rapidly at this time now with all of the Federal Reserve actions. Historically, it's when it comes out of that yield curve inversion that a recession follows. Specifically, this is the fastest it's ever moved over the last several years, going back to 2013. The gold-silver ratio has never been like this before ever. Silver is just absolutely punished. The way you look at it on any indicator at all, from any angle, it's completely ridiculous. So both silver and gold have come down in the near term, but silver has really been punished. This is because of liquidity that's going on with the dollar and so on. Many have expected both of these to rise considerably if the problems do go on. Central banks are buying up mass quantities of gold, and we usually see silver trading roughly with what happens with gold during their bull markets. And to finish off the video, the world is in recession. That is Goldman Sachs telling us where we're heading. Doesn't surprise me though, because this is simply affecting so many different industries on such a broad level. It will be extremely difficult to recover in a short period of time. That's all for this video. If you found it informative, hit that thumbs up button. When you click that like, you're supporting me. Thank you very much. You can find me on all platforms out there. Just search The Money GPS. You don't have to see it on the one you're currently on. Check me out basically everywhere. I'm there. If you want to learn how to actually make money online, right now the sales online have skyrocketed. A lot of people don't know about it. If you want to learn for free, I have an e-course, the AmazonGPS.com. If you want to understand money fast, my 2 books give you everything that you need to know. I'm talking about the foundation, the history, the asset classes, all those details. Check it out. Link in the description if you want the audiobook, themoneygps.com. Well, you made it to the end of the video. Thank you very much. I bet you're wondering, what is the solution? How do I actually deal with all of this? Check this out. This is what you need to know. Click on it. I'll see you there.